Coming up on Business Incorporated. East African Central Bank's cast shadow of doubt over proposed implementation of single currency regime by year 2024. Nickel trade halted in London markets after unprecedented 250% spike. Africa Development Bank avails $10.5 million towards technical assistance in Zimbabwe. Great to have you join us on Business Incorporated. I'm Ladi William. First off, let's take a look at what's happening with the markets. Begin with Africa, where sentiments were negative at intraday. Nigeria's main index was down 0.16%, while South Africa's GSC index fell about 1% at intraday. Similarly, Egypt's benchmark index dipped 3%, while Kenya closed Monday's session negative, down over 1%. And over to the Middle East, where indexes traded mostly positive. The Abu Dhabi main index was up 0.62%, while Dubai's index dropped by 0.2%. Elsewhere in the region, Saudi Arabia's main index rose slightly by 0.19%, and the Qatari exchange traded in positive territory, up 0.67% at intraday. And now heading over to Europe, see Russia threatening to cut off European natural gas supplies if Western allies stop buying Russian oil. The German Chancellor has also reacted to this. Let's hear more now from Rob Watts right there in Berlin. Great to have you, Rob. So Russia's been responding to calls in Europe and the U.S. to ban imports of Russian oil. What has Moscow been saying?
Well, Russia's Deputy Prime Minister, Alexander Novak, says that if that were to happen, Russia would have every right to retaliate, as he put it, and would seek to hit Europe's energy supplies by stopping supplying natural gas through its main pipeline to Germany. That's the Nord Stream 1 pipeline, which transports 55 billion cubic meters of natural gas to Western Europe each year. The EU gets 40% of its natural gas from Russia as things stand. It also gets 30% of its oil from Russia, and Novak argued that it would be impossible to find a replacement for Russian oil on the European market. He said it would take years and it would be European bill payers who were hurt the most. But for all the pressure not to act from Russia, the US and Europe are also under a great deal of pressure from Ukraine to ban Russian imports. All the uncertainty this is creating over oil and gas markets is continuing to cause the prices of both commodities to rocket, and that's already visible here in the costs of fuel at petrol stations and also in people's energy bills, which are already surging as a result of the pandemic supply shortage.
All right, Rob, so is a Western ban on Russian oil imports actually going to happen?
Well, that is, of course, a key question, because it would appear that, for the moment, many European leaders are not on the same page as the United States on this. We've heard from the German Chancellor, Olaf Scholz. He said that EU sanctions had deliberately avoided Russia's energy sector precisely because Europe can't secure its energy any other way, at least at the moment. So he rejected the idea of an import ban. Meanwhile, the Prime Minister of the Netherlands, Mark Rutte, said it was a painful reality that the EU was still very much dependent on Russian oil and gas, and that forcing European companies to stop using it would have enormous ramifications around Europe, including in Ukraine. He said the EU would have to reduce its dependency, but that would take time. And on that idea, the EU Commission is due to set out proposals for doing just that, weaning member states off Russian oil and gas as quickly as is practicable. Meanwhile, the Reuters news agency is reporting that the US might be willing to go ahead with an embargo without its European allies. But you do have to bear in mind that the Americans get only 3% of their oil from Russia compared to the EU's 30%.
Okay, so we know the natural gas prices hit more record highs, Monday. What else is happening on the markets where you are?
further losses on European stock markets on Monday. Frankfurt lost 2%. The losses in London and Paris were more modest, but they were still down. As well as European gas prices hitting new records, we've also been seeing other commodities that are sourced from Russia and Ukraine rallying in price. The prices for both nickel and wheat have just hit all-time highs. All eyes are now on central banks now as investors consider how policymakers are going to tackle the clearly prolonged period of higher prices that we are going to see as a result of the war in Ukraine. And analysts are expecting a tougher investment environment as we move down the line. As for right now, though, well, after big losses on Wall Street on Monday, Asian markets on Tuesday were a little calmer, still mostly losing ground, but not to the same extent we saw yesterday. We'll have to see if Tuesday brings a calmer day, all in all, for markets here in Europe as well.
Right. All right, Rob, thank you so much. That's Rob Watts right there in Berlin. All right, now let's head on to London with Juliana. Great to have you, Juliana. So I see British government is facing a hefty charge to the EU after a ruling by a European Court of Justice. Tell us about this.
Yeah, this is a long-running case, Laddie, involving the EU and the UK government to a time between 2011 and 2017 where Britain was a full member of the European Union. Now, because of what the British government considered lots of bureaucracy, they decided to implement their own customs declarations, and the EU found fault with the UK's system because, according to the EU and of course according to the ruling of the highest court in Europe, that system allowed tens of thousands of cheap Chinese goods and textiles to flood the British market, therefore gain complete access into Europe and dent competition. So the ruling today has found that the United Kingdom failed to fulfill its obligations under EU law by failing to apply effective customs control and measures to enter in the accounts the correct amounts of customs duty. So basically, the quality of this content was so low, but when they were imported into Britain from China, their value was upended, and Her Majesty's Customs failed to acknowledge this. So, of course, now the British government cannot rule or try to come up against this final ruling because it has come from the highest court in the land. I believe the EU is seeking a compensation of upwards of £1.9 billion. I'm sure the Treasury are not happy with that whatsoever.
No, that's a massive amount right there. But another story now. See, a think tank, Resolution Foundation, warns of record high energy prices amid the Ukraine war could lead to a hit worth £1,000 per household. That's a lot of money.
Yeah, it is a lot of money. It's really going to hit not just low earners, actually. It's also going to hit middle-income earners. We've been talking about this year of the squeeze for British consumers and British families, and we were talking...
Hello, Juliana. I don't know if you can hear me.
As Ofgem, the regulator, has increased the price cap. And then, of course, now we've got this Ukraine invasion, which has really significantly pushed up the cost of oil and gas, as well as other commodity prices. We saw motoring groups over the past couple of days, the AA, the RAC, who are monitoring very closely the cost of petrol and diesel. It's increased by about 50p over the past year. We know a barrel of Brent crude has increased by $40 a barrel since the invasion started about 12 or 13 days ago. And it is going to hit families. We know that oil and gas is used everywhere to transport food to shelves. and there's only so much retailers are going to buckle this price trend. It will trickle down. Now, at the moment, we believe inflation is running in this country by about 5.4%. The Bank of England have forecast that it could peak at about 7.25% next month, but the Resolution Foundation say it could go as high as 8.5%, which is a lot of money, and they are calling on the Chancellor Rishi Sunak during his spring budget, which he will be delivering in the next couple of weeks, to do more to support low to middle income families. Now, the government have responded to the Resolution Foundation's announcement today. They said they've already put a package of support worth £20 billion. This includes freezing council tax. Well, no, actually, they're offering council tax discounts. They've frozen fuel duty, which some observers are asking they should reduce that from 20% to 15%, in line with what other European countries are doing. But it just doesn't seem to be enough. So we're all waiting for D-Day, which is the month of April, springtime, when hopefully it could get a little bit warmer in this country, so people wouldn't be putting their heaters on. But of course, they have to eat, and to do that, you have to burn gas. So yes, it's not looking great in this country at the moment.
Yeah, squeeze continues there. But how are the markets holding up?
Well, yeah, yesterday we saw significant losses. Some of those losses were gained back earlier today, but the FTSE still really not, still very much in hot water. Then we just got that breaking news, didn't we, a couple of moments ago about Shell. Shell, which is a London-listed huge oil and gas firm. They've benefited significantly since the invasion of Ukraine, but they've announced that they are no longer going to be importing oil from Russia, which is a significant statement. Don't have the market reacts just yet, but of course we did hear over the weekend Anthony Blinken, the US Secretary of State, suggesting that perhaps the West should go that way, and Shell have been the first big firm to say they're no longer going to do that. Let's see what the retaliation will be from Russia. The FTSE All-Share at intraday is up 0.02%. The FTSE 100 is up by 0.01%, and the FTSE 250, that domestic market, that's up by 0.78%. In the currencies market, the British pound is currently trading up against the US dollar by 0.01%, though it's down against the euro by 0.27%, and it's up against the Japanese yen by 0.30% at intraday, Laddie.
Right, I guess the markets are getting a little breather, at this moment. All right, Juliana, thank you so much. Enjoy the rest of your day.
Thank you.
All right, now let's take a look at what's happening in Asia. We see stocks fell today with mainland Chinese stocks leading losses regionally. The Russia-Ukraine war continued weighing on investor sentiment there. Mainland China's Shanghai Composite fell 2.35%, closed at 3,293 points, while the Shenzhen component fell 2.61% to 12,244 points. The CSI 300 index, which tracks the largest mainland-listed stocks, shed about 2.01% to 4,265 points. The Hang Seng Index in Hong Kong, which led losses among the region's major markets on Monday, continued declining as it slipped 1.71% as of its final hour of trading. In Japan, the Nikkei 225 slipped 1.71% to 24,790 points, its lowest close since nearly November 2020. While the Topix Index shed 1.9% to 1,759 points, South Korea's Kospi dipped 1.09%, finishing the day at 2,622 points. And stock futures rose slightly today. The S&P 500's worst day since October. That was yesterday, as investors remained on edge about surging oil prices. Futures on the Dow Jones Industrial Average claimed about 33 points to add about 0.29%, while the S&P 500 futures traded 0.38% higher. And the tech-heavy NASDAQ 100 futures was up about 0.13%. The overnight action came after a steep sell-off on Wall Street, where the S&P 500 dropped nearly 3% for its biggest one-day decline in more than a year. The blue chip Dow tumbled almost 800 points for its fifth negative session. The Nasdaq Composite, which contains many markets and the biggest tech names, slid 3.6%, falling into a bear market territory, down 20% from its record high from November. Investors continue to monitor developments of escalated geopolitical tensions at Russia and Ukraine. All right, we'll take a break now. When we come back, we'll look at what's happening in the commodity space. That's in a moment. Just stay with us. Welcome back for Commodities Update. Now we see almost every commodity has witnessed a stratospheric surge in prices in the last fortnight. This is due to the invasion of Ukraine and the possibility of an escalation in the war. Particularly, the global food price index is up about 3.9% to an all-time high of 140.7 points in February. Russia is the third largest producer of wheat. Ukraine, ninth place. Both countries account for over 30% of global wheat exports, and the global price of wheat has increased by 152% to $45,342 per metric ton in the last 2 years. Let's talk to Favor Ogunraye now, analyst at Financial Derivatives Company. Great to have you, Favor.
Thank you for having me, Nadi.
Yeah, so what is the short and long-term impact of, higher wheat prices on the Nigerian economy? Bear in mind that food inflation currently stands at about 17.13% in January 2022.
Okay, so if you analyze the uptrend in wheat prices, you see that this spike is as a result of the rising risk of a supply shortage due to what's happening between Russia and Ukraine. You see that the wheat shipments coming from these two large producing countries, we think that they cannot be accessed, and there's also this complexity that comes with having to navigate the sanctions that have been imposed on Russia rather. And for Ukraine, you see that their agricultural activities are they are experiencing some sort of unexpected situation where farmers can't go to the fields to carry out their usual activities. And we've seen that some of these farmers have even joined the military just before the next planting season. And what countries are doing to mitigate this risk is to either, expand their local production, or they are forced to stock up, imported wheat. But then for a country like Nigeria, we can't really depend on our local production because we locally produce about 2% or less of the wheat we consume. So that means that, due to imported inflation, the price of the cost of flour, of bread, of pasta, of all these pastries will increase. And if you also consider the exchange rate pass-through effect, that would significantly push these prices up. But then that will happen in the short term. But then in the long term, a lot of factors will come into play. And that includes, the success rate of CBN's rain-fed wheat program that was launched last year, and also how the government is able to manage the insecurity that is happening in, the wheat-growing areas in the northern region. So all of this coming together will show us the extent to which Nigeria can be self-sufficient in a situation like this.
Right, and Flour Mills of Nigeria is a dominant player in the flour milling industry, and Olam, I think, ranks second. Both companies control about 90% of the market share. What would be the impact of, increasing global wheat prices on the company's performances for 2022?
Well, there will definitely be cost implications. So the production cost of, flour, of all these flour derivatives will actually increase because wheat is an important input that is used, and, the price is going up. And then we've also seen that this upward trend in the global price of wheat is actually feeding into the price of local wheat here. So for Flour Mills of Nigeria, who has this, backward integration program, we see that, and the program includes some sort of strategic partnership with farmers. But then we expect that they will still feel the heat, either internationally or locally. But what they can do to reduce the impact on the bottom line performance would be to pretty much pass on costs to consumers in form of increase in the price of their product. But then the extent of that price change is actually actually quite dependent on, consumers' behavior, because that will affect the volume of the products that will be sold. So in 2022, we could see a slow growth in the top line and the bottom line, compared to 2021.
All right, let's look at consumer reaction now. We've seen a bag of flour prices surge by 151% about 12 months, but we've seen prices of beans and gari down about 58 and 3%. At this point, do you see consumers switching, substituting at this point?
Well, theoretically, if you look at the concept of cost elasticity of demand, we see that, the price of one product, the change in the price of one product will affect the demand in another product. And, that kind of relationship is positive if you look at substitute goods. So, in this context where the price of bread, the price of flour, pasta has actually increased, and then the price of gari and of beans has declined, and if you also consider consumer disposable income, which is relatively constant, it's natural for us to see that switch, or they could either reduce their consumption level if they actually consider this consumer goods a necessity. We could see them reduce their consumption level, or they will switch to rice and to beans and gari.
Right. So anyway, we'll keep watching how it all unfolds with all the supply disruptions at the moment. All right, Favor Ogunore, thank you so much, Analyst Financial Derivatives Company. Thank you for coming on the program.
Thank you for having me.
All right, now moving on to South Africa. We see their gross domestic product has increased by 1.2% in the fourth quarter from October to December 2021. Statistics South Africa announced these figures today. Personal services, trade, and agriculture played a bigger role in the GDP growth, with personal services increasing by 2.7%. Exports and imports also did great in the fourth quarter, with exports sitting at 8.5% and imports at 8.9%. Statistician General Senga Maluleke says the economy grew in 2021 compared to 2020, with the economy sitting at 4.9%. Maluleke says despite the improvements, South Africa is not out of the woods yet. Take a listen.
We are saying that our quarter four GDP grew by 1.2%, and indeed as it grew by 1.2%, when you look at its growth in the fourth quarter of 2021, we haven't come out of the woods in terms of COVID-19, because our economy having gone up, our real economy is sitting at about 1.126 trillion rands, which is equivalent to where we were as of the third quarter of 2017. Having said so, our economy in the year 2021, because the fourth quarter then brings all the combination of the quarters, has grown by 4.9% on the production side. And of course, we see the biggest contribution as of the fourth quarter was from personal services. And while the biggest growth in terms of growth rate was from agriculture. Agriculture grew by 12.2%. Now, when you go to the expenditure side, our economy quarter on quarter as of the fourth quarter of 2021 grew by 1.3%, whereas the annual growth from the year 2020 is 5%. We see that both imports and exports have done very well, sitting at 8.5% for exports and 8.9% for imports.
And East Africa central banks have cast a shadow of doubt over the proposed implementation of a single currency regime by the year 2024, citing delays by member countries in realizing targets set out in the Monetary Union roadmap. The single currency regime is expected to eliminate transaction costs of exchanging currencies and remove exchange rate volatility in cross-border trading activities. The banking regulators, through the East Africa Community Monetary Affairs Committee, noted that while significant progress has been made towards the realization of a monetary union, there are several challenges that could still impede the timely implementation of its protocol. And the London Metal Exchange suspended trading in its nickel markets after an unprecedented price spike left brokers struggling to pay margin calls against unprofitable short positions and a massive squeeze squeeze that has brought the largest nickel producer as well as major Chinese banks. Nickel used in stainless steel and electric vehicle batteries surged as much as 250% in 2 days to trade briefly above $100,000 a ton early this morning. The frenzied move, the largest ever on the exchange, came as investors and industrial users who had sold the metal scrambled to buy the contracts back after prices initially rallied on concerns about supplies from Russia, while brokers rushed to collect margin payments to cover their deeply unprofitable positions. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye-bye.